Good afternoon, everyone. Welcome to this instalment of the Hydrogen Energy Association's Hydrogen Bytes. I'm going to give it a moment to let a few people keep entering the meeting, and then we'll get going. Thank you very much to everyone who's joined already so promptly. Today we have Daniele Manzi from Close Brothers to give us a presentation about their products and services. So I will give a brief introduction into the HEA to begin with. Then I'll hand over to Daniele for about 20 minutes of presentation, and we will then conclude with around 5 to 10 minutes of Q&A. So I really encourage any questions to be put into the Q&A session section or the chat, and we will come to those at the end. Any questions are very welcome. We'll just give it one more moment. There's still quite a few people coming in. Brilliant. Okay, so thank you for joining. I'm Lucy Woodward. I'm the policy analyst at the Hydrogen Energy Association, and these Hydrogen Byte sessions are our frequent sessions where we showcase member opportunities, member projects, services, and everything else in that bracket. So these are our current members, and we represent around 100 companies from across the hydrogen value chain from a range of different services. So production, transportation, hydrogen end use, materials, components, testing, instrumentation, and also represent some consortium members and universities. So that's the Hydrogen Energy Association, and now I'm going to hand over to Daniele Manzi from Close Brothers. So over to you, Daniele.
Oh, thanks, Lucy. Much appreciated. See if I can share my screen.
Yep, go for it.
And we're even going to presenter mode. Just shout out, is this working?
It's just loading, and yeah, that's working fine. Over to you.
Excellent. So yeah, Daniele Manzi from Close Brothers. I'm just going to take you guys through a pretty simple presentation, and maybe we can get into some detail in the Q&A. But a quick introduction to Close Brothers. What is asset finance in particular as a form of debt finance? How and why asset finance works in the hydrogen space, and then where we're trying to apply this. So Close Brothers are a constituent of the FTSE 250. We've got around 3,000 employees, 35 offices, UK-based merchant banks providing debt finance. A loan book of about £10 billion, and we've had a focus in energy transition for quite some time. Over the past 10 years or so, we've done £1 billion of energy projects, and we've also got commitments in terms of funding EVs. So we do about 150 million electric vehicles per year. That's growing year on year, obviously, as the businesses transition into EV. And in particular, Close Brothers likes to focus on the small or the SME portions of the small and medium sized projects and that maybe the larger banks aren't set up to service. On the bottom right of this presentation, you can see our CEO mentioning that expertise is something that we're really focused on, i.e. when we get into a sector, we like to really know that sector. We take some time to explore it, do the right due diligence in the sector, and then try and deploy capital at scale. So now, just what is asset finance? If Close Brothers is a debt finance provider, focus on asset finance. What is asset finance? Well, asset finance essentially allows businesses to pay for equipment and then spread the cost of that capital over time. In most cases, there'll be absolutely no change to any business's standard procedures, i.e. selling process will be the same. Rental payments will be similar to what you used to do. It's just Close will be paying for the equipment. It's really quite a simple process, with the main benefit being instead of paying loads of money up front, you spread that cost over 3, 5, 7 years. Very cash flow friendly and a very simple form of finance. It's we offer other forms of finance, so sort of contracted revenue, receivables finance, project finance. But asset finance seems to fit best in this space, mostly because at the types of projects we're looking at, maybe 20 megawatt and under, we don't. It's not necessarily while taking out all the relevant due diligence that would be required for project finance. So on both on the feedstock and the offtake, but happy to take questions around that. We're funding the whole value chain, so production, transport, end use, and what that means is all the assets will be fundable by Close Brothers. So electrolyzers, compressors, MEGCs, MCPs, HPUs, and other end use equipment. I think what changes throughout this value chain is maybe the sort of leverage you can offer. The way we think about these bits of equipment is, are they what's called DIN, so durable, identifiable, movable? Most importantly, do we think we can track them, and do we think we can sell them if anything goes wrong? So maybe a massive piece of equipment like a electrolyzer might have a slightly lower leverage we can associate with it versus a MEGC that you can move around and sell and lots of people are trying to use. And so it really depends on the type of equipment. I think importantly, we try and be as pragmatic as possible here. So yeah, if there's a project with a whole host of different types of equipment, we try and think holistically about how we can most safely or most prudently increase the leverage on those projects to support our customers. So why does asset finance work well for hydrogen? Due to the fact that it does. Well, many of the projects are really quite capex heavy. The assets are long life and redeployable. They're income generating. So this is a massive thing in asset finance. Are these assets important for the daily operations of the business? In most cases, yeah, your hydrogen assets are supporting important projects, either because they're revenue generating or because they're important for the prestige of a particular business, and that's useful from our perspective to acknowledge. They're also large, modular, and trackable, i.e., they're not specific to particular projects. They're large, they can't just be stolen and picked up. It's always heavy and difficult to find, and they're trackable. So we can stick trackers on them and work out where any asset is at any particular point in time. So really quite easy to track, fund, and place. Yeah. So we've been working with a whole host of different companies. I think one that we've articulated to the market, and we have case studies around, is GeoPura in the hydrogen space. We fund their value chain, but in particular, we're really proud of funding their HPUs, as this is a sort of new technology. Yes, it has a Siemens wrapper, as I'm sure you know, but really it's a new technology being deployed into the market. So really great that we could provide the or undertake the due diligence required to lend into this type of market at scale, and not just the standardized equipment like MEGCs. I actually think that covers very briefly and broadly what we're talking about. I wonder if we just open up to questions there, or I can go into detail around the structures, etc. But I want to keep this fairly high level for now.
Thank you. Yeah, that's perfect. Really interesting presentation. Thank you for offering all of that insight. I would encourage anyone at this point with any questions to leave those in the Q&A function. Any relevant points are very, very welcome. Maybe I'll kick us off with a question around hydrogen compared to other areas that you offer investment for. So how do you see the hydrogen landscape developing, and what are the sort of particular challenges that you feel you can particularly unlock for hydrogen compared to other spaces?
Yeah, so I focus on energy transition in particular, and from an asset finance perspective, these are really quite challenging areas to fund, because I guess the first thing to recognize is we're providing debt finance. Debt finance is asymmetrically loss making. So it doesn't matter how well a project or business does, your return is always your interest rate at best. But if anything goes wrong, your return is essentially massively negative because you lose all the capital investment. So one loss wipes out a whole host of profitable projects. So that's the first thing to note. The second thing to note is normally what asset finance businesses do to protect against that downside is have assets that can be sold. Now, in energy transition markets, those assets often they don't have demonstrable secondhand markets, they're novel markets. And therefore you can't assign easily value to those assets, which means debt finance automatically becomes harder because you can't, if anything goes wrong, sell the assets. If you're doing EV infrastructure, you can't rip out the charging cables and sell those separately. You can, you just won't get very much money. It's a lot of effort. So I guess the first thing to note is hydrogen is a niche market, but from an asset finance perspective, if you take that view, it's actually quite solid and stable. Where we think we can support and where our focus is smaller projects. Once you get into 50 megawatt plus, project finance becomes much more viable. People are willing to put in the effort to do the amount of due diligence required to essentially complete on the project finance. When you get below that, we see continuously through our partners that finance becomes a real struggle, and that's really where taking a different view on risk becomes relevant. So moving away from is this project going to complete, and towards who's buying the pieces of equipment and are they valuable in their own right, I think is where our expertise really comes in this space. That's opposed to other transition markets. There actually our structuring becomes a lot more relevant. So if you're looking at EV infrastructure, it's much more around to what extent can you contract merchant revenues on your EV charging versus can you sell the assets. So it's much more structuring approach, and in other markets it becomes a bit more structuring, a bit less asset heavy. In this space, asset finance seems to be the way to go.
Amazing, thank you. We had a question from Nigel, which is what power rating are the HPU? So I suppose that's a specific question about one of your slides. I don't know if you want to pull that up again.
Yeah. To be honest, when we get into the power rates and the technical, I don't want to speak on behalf of GeoPure because I know I'll get this wrong.
No worries. There's probably people from GeoPure here, so I don't know if I can invite them to comment, but maybe I'll let you speak first.
No, I mean, I invite anyone to save me on the technical questions. I think if I was to speak to GeoPure, why we see them as such a valuable partner, well, in that case, whilst it is a quite novel technology, they obviously have the experience and engineering scaling ability of Siemens Energy, which it just adds so much credibility to that product. Obviously, they own the IP, massive boon from our perspective, and obviously their client base is really tier one. And again, I'll pause so I forget what's public and not, but clearly,
no
I think
problem.
Lower Thames project massive.
Yeah. A question from Sam: when you're underwriting an asset like an HPU or electrolyzer deployment, particularly where the operator is coming from an adjacent sector like oil and gas or construction, do you currently factor workforce competence into your risk assessment? And if not, should you?
100%. I think that's super relevant. If you are coming from that sort of industrial background, I think risk is a massive health and safety risk. These are massive factors that are commercially thought about. I used to work at Balfour Beatty, and there was a massive thing there. But you can tell when you go to site whether or not a particular counterparty is taking risk seriously. If they have the background of working with high risk chemicals or in high risk sectors, often it's the case that they can. You can see the thinking has gone into it as to when you go to site. Are they treating the equipment fairly? Have they trained their staff? Do you get a health and safety tour at the start, or is it just like a PowerPoint on a laptop, something like that? It's quite clear. Do we think about it? Yes. I mean, honestly, when we go into these sectors, the first question any credit committee is going to ask is what goes wrong. And the way we tend to think about it, not being technical and really being financial, is we take out third-party due diligence. Health and safety becomes part of that, but it's the standard third-party FDD and technical due diligence you'd imagine. So DMV, Arup, those type of companies have specific technical teams that can support us, and we essentially partner with them, pay for reports to ensure that those things are considered.
Great, thank you. And there's a question from Harriet. What sorts of leverage levels might you expect to see on typical hydrogen assets?
So that depends on the type of asset. Assets that can be redeployed into other markets. So something like a MEG-C, movable containers of gas, easily redeployed to other gases. That might be a very high leverage. So 90% might even get to 100% leverage on that versus invoice value. If you get into more niche, so sort of PEM electrolyzers, that might be more like 60% leverage. Because you need to find even if you think you can sell the asset for quite a bit of money, you have to find a project to redeploy it to. You might need to work with the OEM. So the OEMs might sign, they're called remarketing agreements. So they might agree to, if anything goes wrong with a particular counterparty, to buy that asset back, well, to help you support reselling that asset through their commercial channels.
Fab. Thank you. We had a response from Charlie from Geopura as to the previous question from Nigel. So the HPU one, which is 250 kilowatts, is scalable up to 2 megawatts, and for the HP2, which is 500 kilowatts, it's scalable up to 50 megawatts. So I hope that answers your earlier question, Nigel.
And to be clear, and thank you very much, Charlie, that's appreciated. But we're also looking at different segments of fuel cell. So Geopura obviously is working with some of the largest, most impressive counterparties. We also think we can support in maybe like the mid and smaller market segments, smaller construction sites, etc., with other players in the market.
Great. Perfect. Are there any other questions from anyone in the audience? Please feel free to leave them in the Q&A function. If there are no further questions, then I will just begin my concluding points. So we're going to share the presentation slides from Daniele around with everyone, and this recording will be available on the Hydrogen Bytes section of the HEA website. So if anyone missed the start, then they can go and watch the beginning of Daniele's presentation there. We have these Hydrogen Bytes sessions fairly regularly, so look out for future announcements about those. Thank you very much, everyone, for attending today, and especially thank you to Daniele from Close Brothers for presenting. It's really, really interesting talk, so thank you.
No, anyone feel free to reach out, by the way. It's absolutely perfect. We've got a team who can support, so please do.
Brilliant. Would you be able to leave your email address in the chat, Daniele? Yep.
Sure.
Great, thank you. Okay, if there are no further questions, I'll finish this call here. Thank you very much. Have a good rest of your day.
Cheers, bye.
Bye, thank you.